to try to share my screen because I got some slides I can talk through. Let's see. Okay, how's that?
Good.
We're good. Okay. So here we go. So today I'm going to talk about some of my adventures in building decentralized apps with Remix and something else called Moralis. So I'll talk a little bit about what is Moralis. It's pretty cool. And if you're interested in building decentralized apps, it's a good thing to kind of bridge what you already know with with what's happening in like Web3 stuff and blockchain. So let's see. So quick intro about myself. So I started life as a physicist, so PhD in applied physics from UIUC. Spent 2 years after that at MIT Lincoln Lab, doing like all kinds of crazy stuff like ballistic missile defense, analyzing space shuttles, that kind of rocket science type stuff. So kind of hardcore math, physics kind of guy. But a lot of those kind of hardcore math physics kind of guys end up on Wall Street. So I ended up kind of heeding the call to Wall Street around 2005 and became what's known as a quant. So doing kind of mathematical modeling for finance. And I did that for a long time. So 2005 to pretty much now, but I was only doing that in corporate environment up to 2014. And between 2005, 2014, I hit pretty much the entire spectrum of financial services. I did kind of quant hedge funds, did traditional asset management, I did buy side, I did sell side, derivatives, mortgage derivatives. I was all over the place. The last kind of corporate stuff I did was insurance. So I was head of risk management at AIA Insurance in Hong Kong. So that was like going back to 2014. And then I've been doing kind of serial entrepreneur stuff since then. So like, I'm like the CEO of unemployed. So there's some funny TikTok stuff going around. So yeah, so I at this point, I'm pretty much unemployable, but I've got a pretty strong background, good education, good finance background, but nobody will hire me anymore because I've just been around doing startups and stuff. So I'm pretty much stuck doing startups now, but it's fun. It's kind of what I'm born to do anyway. So anyway, so today, like my goal for today is kind of put on my professor hat a little bit, and hopefully, you guys can learn some stuff. I don't know what kind of background you guys have in finance. Maybe you can teach me, but so maybe we'll start out like learning a little bit about traditional finance and why this DeFi even matters. Why does decentralized finance matter, and where does it come from? And then for sure, I will be talking about how to build this stuff a little bit. But yeah, I think kind of the lion's share is just kind of learning about, where this is coming from. Then I'll talk about my experience trying to build stuff. And like when we talked about doing this, I kind of gave a caveat. I said, well, I'm not really a web developer. I'm a technical founder, so like I can build kind of MVPs and I can build stuff. But at some point, I'll probably need to hire a professional to actually make it good. But I'll show you some of my experience and we can see where it's going. So kind of like where I want to start talking about traditional finance is kind of rewinding a little bit. So I'm kind of an old guy, the boomer, TradFi boomer kind of guy. I've been around for a while, and I was actually working at one of the largest asset managers globally when kind of the global financial crisis happened. So I kind of front row seat of what happened. And I don't know how many of you remember this or experienced this, but there's two kind of big things that happened. The kind of crack in the financial system happened in July 2007. The first cracks of what became the global financial crisis happened when two Bear Stearns hedge funds imploded. So they had very highly leveraged bets on the subprime mortgage derivatives, and those kind of went south. And so these two hedge funds kind of blew up, and I was working at a company called Capital Group. They had like 1.3 trillion with a T, trillion assets under management at the time. We were one of the largest asset managers in the world, but we're always like 1, 2, or 3 in terms of trading volume at the large investment banks. So we had great access to what's going on, world-class economists and et cetera. So I, like I said, front row seat what's going on. August 2007, this news came out about the bankruptcy of the Bear Stearns hedge funds. But I think what most people, if they remember anything about that, was probably the Lehman Brothers. So if you point back to like what happened to Lehman Brothers, they kind of point at Lehman Brothers, a collapse that happened about little more than a year after that. So things were kind of like crumbling for about a year before Lehman collapsed. And and ironically, it's kind of funny because I used to work on Wall Street. Like I said, I was at Citigroup, and so when I went to Capital Group, Lehman Brothers, ironically, I think like people might look at Lehman and say, "Oh, they were so horrible. They had the worst risk management. They deserve, but that's actually false. History is written by the conquerors. But Lehman Brothers is actually one of the finest investment banks. They actually had the best risk management. I think my theory is kind of like they were thrown under the bus because they could. Like if somebody tried to throw Citigroup under the bus, it would have been much worse because their risk management is pretty horrible. So anyway, September 2008 was pretty historic moment when Lehman Brothers collapsed. But how did we react to that? We reacted by bailing out the banks. That was pretty miserable, and that created kind of a divide in the country and even globally about like, should we bail out the banks, these zombie banks, et cetera. So if you look at, when I rewind myself to that time, like I was thinking like, I believe in free markets, I believe in capitalism. If those big banks really fail, there should be this great opportunity for local banks. So I remember I was very tempted to try to raise some money at that time to open a local bank, because I said, oh, when the Citigroup fails, all these banks fail, there's still going to be a need. People need to put their paychecks somewhere. So these kind of local credit unions, they should be very strong coming out of that. But what I didn't account for was these bailouts. I never imagined trillions and trillions of dollars would be going into bailing out these banks. So I was totally wrong. But while I was thinking about doing that, which I'm glad I didn't, but other people were thinking about something else. So this happened. This is something that appeared January 3rd, 2009. This is the first block in the Bitcoin blockchain. And the thing I want to point out about this kind of hexadecimal gook here is that it's like this little comment about Chancellor on brink of second bailout for banks. So really this first block of the Bitcoin blockchain was, first it's a technological, very cool thing that happened, but also it's a protest against kind of the bailouts, and I was quite unhappy with the bailouts of the banks, and I wasn't the only one. So Bitcoin in a way was kind of a protest against the established financial system and people trying to break free from that system. And so kind of like in the spirit of the original internet, where, the original internet was developed to withstand nuclear war, this kind of decentralized internet. Similar with the Bitcoin, nobody can ever shut this thing down. Like even nuclear war will not stop the Bitcoin blockchain. The China shutting down miners, US, nobody can ever shut down Bitcoin. And so it is kind of like an interesting thing where it's technology plus a bit of politics plus a little philosophy, et cetera. Kind of interesting. Then so that was 2009. And then, between 2009, 2014, in this kind of 5 years, something very interesting happened, because people started to realize the potential of a decentralized system, this kind of permissionless, trustless blockchain. And then that's when Vitalik Buterin kind of introduced Ethereum. I put some QR codes here, so if you're interested, have a look at it. This is a really great video. I mean, frankly, I've watched this like several times a year since 2014. It's just so much insight there. I look at it, I almost think like this guy is an alien from another planet, because it's so interesting the way it works. So definitely check out this if you haven't seen it. I definitely recommend having a look at this talk where he introduces Ethereum in 2014. So what is Ethereum? What is a blockchain? You know, in very simplistic terms, you know. But another caveat I want to make is that I'm not really an expert in any of the stuff I'm talking about. So I could, if there's experts out there, you can definitely catch me up. So like probably the best way to listen to this is more like a story. I'm telling a story. I'm not giving like an academic lecture or something. So it's really more about, I'm trying to convey a message. So Ethereum, in very simplistic terms, can think of it as a state machine. You have states and you have transitions. And that's where the blockchain, the chain and the block comes from, is you have states and transitions between states. And the cool thing about that is, like I said, it's completely permissionless, completely trustless. You know, there is no central computer, there's no central backend that's running this. It's running on, you know, thousands or tens of thousands of nodes. And so it's a state machine, but what is it? It's an extremely slow state machine. So the power of this thing is probably like less than your pocket calculator. You know, the amount of calculations you can do with this stuff. It's not about powerful computing. It's about trustless, decentralized computing. So what can you do on this kind of Ethereum, this kind of decentralized world computer, if it's so slow? And you know, some of the first things people tried, obviously, were financial services. So I'm going to talk about some of the financial services that people tried to implement on blockchain and why they failed. And then, you know, what were the alternatives and what worked and where we are now. So this is one of my favorite pictures. I don't know, can you see my mouse? I hope you can see my mouse there. Okay, yeah, cool. So this is what's called an order book. And I don't know if you've seen this kind of chart before, this kind of depth chart. But what we have on the x-axis is prices. So think of this like a stock, like a stock exchange, and you have prices along the bottom. And then these are like number of shares. So down here, this would be like, if you want to buy a stock. So let's see this 50 right here. Let's say I want to buy like 200 shares of the stock. Then you can kind of think of it as that order, if it's a market order, is going to gobble up this heel until it gobbles up 200 shares of this stock. And in doing so, the price is going to move up. So these all represent what's called limit orders in the stock market. So I don't know if you've done much trading or not, trading stocks in your retirement portfolio or something, but so you have market orders and limit orders, and you know, away from this point right here is the current market price, and away from that, these are all called limit orders. So it's kind of cool. I was looking for a movie of this because I remember seeing one of the famous financial engineers, his name is Doyne Farmer, back in 2001 at University of Chicago, presenting a movie about the order book. And it's just fascinating to kind of watch this thing, how it kind of gobbles up orders, and you know, the price moves up and down, left and right as it gobbles up orders. And that's how, you know, stock prices are determined. So when you're trading a stock, it's really an order book, and you're gobbling up these kind of orders. So the price goes up and down as you gobble up orders. And then, so what does that really mean? What that means is like some central authority is collecting a bunch of orders. So every little point here is kind of like an aggregate of a bunch of orders. So if I want to buy with the limit order, then my stuff goes on this side. If I want to sell with the limit order, my stuff goes down here. So some central authority is collecting like thousands or tens of thousands or millions of transactions into an order book and kind of generates this chart. And so that, in a way, kind of one way to describe that is it's peer-to-peer in a way, because you're looking for transactions. Somebody wants to buy something and somebody wants to sell something, and you're trying to match those two together. And then, but it is centralized because one person, you know, one entity is matching these orders, and you don't know if they're going to be honest, or you don't know if you can trust that person. somebody might say, hey, my order's up here, but I'm gonna sneak it in at this lower price, something like that. So there's some level of trust required for this whole thing to work. And it's very data intensive because every single order needs to be matched. So like I said, if you try to imagine doing this on your pocket calculator, it's not going to work very well. So like probably your phone has enough compute power to do something like this, but probably not like a pocket calculator. So if you're doing like a very weak compute engine trying to do this stuff, it's really going to get clogged up. So initially in the early days of Ethereum, people tried to do something like this, try to implement an order book on the blockchain, but it's just not very effective. It kind of clogs things. It just bad user experience. So now kind of fast forward again to November 2018, which now we're, in crypto years, 4 years is like infinity. So things are just moving so fast that like to me, I'm kind of an old guy. So like 2018 is like yesterday to me, but like it's in crypto terms, it's forever. But this is something called Uniswap. And so I'm not sure if you've heard of Uniswap. I'm not sure, like the people listening, how experienced you are in the DeFi, but Uniswap is something called an automated market maker. And they were not the first automated market maker on the blockchain, but they're the first one that kind of gained traction. And this concept is quite beautiful. And like, it was kind of born out of this need to kind of match trades. The whole point of a market maker is you try to make a price. So if you go back to this guy, the whole point of this is you're trying to say, what's the price of this stock? This stock is effectively the equilibrium point between the buy orders and the sell orders. So this equilibrium point is the price of a stock. So how can you determine the price of a stock or a price of a currency without having to do that? And that's what automated market makers do. And Uniswap was the kind of first one to make it work. So kind of quickly, what is it like? So what is this? So like I mentioned, the kind of order book stuff, you can think of that as peer-to-peer because it's like you got one person buying something and somebody else selling something, you're trying to tie those together. But with the Uniswap, what they did is it's a peer-to-pool. So on the one side, you have people so I'm using like US dollar and euro just as an example to kind of understand, but it's more general. These could be tokens on the blockchain, but just conceptually, this is how it works. So say on the right hand side here, you have people that own US dollars. So maybe I'm saving, I've got some savings, or I'm an insurance company, I'm holding some US dollar for the future if I have to pay some insurance claim or something. Whatever the case, I have some US dollars, and what are you going to do with it? You got to put it somewhere. So in the case of this kind of peer-to-pool concept, you would put those US dollars into a pool. And then now the same person or different people might have some euro, and they're going to also put euro into a pool. So now I have kind of two pools. And with this kind of automated market maker, what happens is when you put your US dollar into a pool, you get something back, which is a liability called a pool token. So in principle, you have this pool token now has some value. Now I can trade the pool token back for either US dollar or euro, but I put US dollar into a pool, I get pool tokens back. I put euro into the pool and I get pool tokens back. The key thing is those are the same token. So you get some other kind of intermediary kind of currency when you put something into the pool. And so now you have this kind of big pool of US dollars and you have this big pool of euro. And now there's another group of people who want to actually trade. Like maybe I'm going to a trip to Europe and I need some euro. So I want to swap some of my US dollars for euro. So now I do this kind of trade from one pool to the other. And so we have two kind of groups of people. On the right side, you have liquidity providers who provided the capital in the first place. On the left side, you have traders or people who have a need to exchange currency. And these two form a very symbiotic relationship because the people with US dollar, they want to deposit and earn interest. the people who want to trade, and when you trade, you end up paying transaction fees. So as you trade your currency, you generate fees. Those fees go to the people that provide the liquidity in the form of interest payment. So that's kind of the symbiotic relationship that's required for this kind of peer-to-pool type thing to work. And so, like I said, on the right side, somebody deposits some currency into a pool and they receive pool tokens. The traders, they don't care about the pool tokens. They're just trading the currencies in the two pools. So, and that all looks great, but like the key question is like, okay, so I receive US dollars if I'm a trader, I receive pool tokens, but how much? You know, what is the value? You know, and that's where the market maker piece comes in. Because the market maker piece is the piece that uses some financial engineering to kind of, in a kind of a black box way, enforce some rules of supply and demand so that you can get a price out of it. You know, so like the way that the exact manner of how that works is kind of beyond the scope of this talk because it's quite mathematical. But, you know, that's the concept of this automated market maker is that there's some mathematics involved that will tell you, like, if I put in so many tokens, how much of another token should I get out? And it's based on supply and demand, like how many tokens are in the pool. So prices, so the key difference between the order book, the price is determined by an equilibrium point of trades in the order book. Here, price is more of an equilibrium point of how much liquidity is in the pool. You know, how many US dollars are in there versus how many euro are in there. And that's kind of what determines the price for the pools and the, you know, how much US dollar you're gonna, so that effectively the exchange rate. You know, so here, so my contribution, kind of my startup is, you know, I've developed a better version. So like I have a better automated market maker. You know, so like if you're interested in the math, I'd love to nerd out with you, but I'm not going to do that here. so like if you're interested in the math, I'd love to nerd out on the math, and so we can talk about that. But I won't get into that at the moment. I'll just put this up there. So this is a paper I published this in November last year, and it's kind of funny because I was looking at, you know, the remix. I'll talk about this later, but just remember the date, November. That's kind of significant when it comes to remix and stuff. So anyway, so if I kind of pause for a second, you know, maybe I can, like you said, if you have any questions so far, I can try to answer some questions. But roughly, you know, Bitcoin was kind of born out of the financial crisis, you can say. You know, and Bitcoin was this decentralized currency, and then, you know, but it was quite restricted in the sense that, you know, there was a scripting language, but it's not Turing complete. You cannot really build applications on the original Bitcoin, whereas Ethereum, you know, now it is this kind of blockchain, but it allows to write what's called smart contracts onto the blockchain. And so now you can build decentralized apps. So decentralized apps are essentially, you know, applications written onto the blockchain. And so, yeah, so any questions before so that was kind of like the background, TradFi, DeFi, and then I'll talk a little bit about, and then also like the math. So like I built this kind of thing because I did the mathematical research, I did the financial engineering, I built this better engine for automated market makers, and then I've implemented it and built an MVP. So I can show you that too, but yeah, so, and then, you know, it's built with Remix, et cetera. But
a quick question for you, Eric.
Yeah, sure, Ray.
On the protocols, you know, there's a whole thing about, is it a protocol, is it an exchange, and all that stuff. But on the protocol side of it, which is like Uniswap and all those guys, you were talking about how the liquidity pool works and all that. Just wanted to see how deep you can go into where's the money coming from. In other words, we know that 1,000, 10,000, 1 million people put money into the pools. Uniswap and a bunch of the others. They've got, who knows, 5, 6, 10 different pools. It's made up of pairs or singles. And they offer various percentage on the returns, right? 7-day, 30-day, 60, right? Well, whether that's a 10%, 20, 30, 100%, 500% return, where's that return coming from? That's where that pyramid thing comes in. That's where the, what is it? What's the other word that everybody's using now? Oh, shit. What's his one? Bernie Madoff went to prison for it.
The Ponzi scheme?
Ponzi scheme, where the Ponzi scheme component comes into play is because, and I'm just curious what you know about it, because it's the area that I'm trying to just focus on, because I've been looking at Autobots for arb trading on those, you know, and and I've been programming that stuff. And so what I find interesting is, you know, you got whatever it is, 10,000 people, and they're all putting in X amount of money. They put that money in. Where does that 20, 30, 50, 100% come from? Where's that return coming from? That's where the Ponzi scheme comes in. And I do know that some of them are clearly doing loans, right? Like AVA and a few others. They're doing flash loans. They're doing loans on equity. You know, you got X amount of stock in there or X amount of currency in there. We'll do loans on that. So they're making money on the loans. But other than that, where's the money coming from that these people are paying these percentages on?
Yeah, well,
Just curious.
Yeah, that's a good question. So like when I first, you know, I come from a traditional finance background too. So like, you know, rates have been low since the global financial crisis. The yield curve has been low, you know, in some European countries, it's negative. So,
and just so you know, you and I are on the same page there. I lived with a compliance officer at Bear Stearns for 25 years. She was a compliance officer. So when the collapse happened, boy, I was in the middle of that, and I got all the details of it. And
we should chat sometime.
And just the average traditional portfolio, diversified portfolio, bond, ETFs, you know, mutuals and what have you. You put a good diversified portfolio together and you're going to get a certain amount of return, just like what you were saying. It's got some stocks into it, a couple of stock portfolios. So you put together a good portfolio, get a certain return. But that portfolio was generating revenue from those entities that they're invested in, right? So so you put money into a bond portfolio, well, those bonds are paying money. You put it into a mutual fund, those mutual funds are paying because those mutual funds have invested in companies and those companies are paying dividends, right? So all of that is the traditional thing of what Wall Street's all about. But when you're dealing with protocols versus the exchanges, right? So Binance and those guys, they're dealing with exchanges, which is dealing with a lot of Wall Street stuff. But when you deal with the protocols, which is just the liquidity pools, all people are doing is putting money into these pools. And therefore, where's the profit coming from that these pools are paying these percentages for? I'm just curious to see what your knowledge might be on that.
Sure. So my like when I first like started hearing about yield farming and stuff, you see like ridiculous numbers, right? Like risk-free rate is 0. How can you offer me 20%? It just doesn't make sense. How can you offer me 200%? That really doesn't make sense, right? So like you would, if you tell me you're going to get like 5%, you know, I put on my traditional hat and I say, well, that's still kind of a stretch when the yield curve is at 0, but it might be possible if you got like some good equities in there, growth stocks or something. But, you know, and so where this does become a little more believable is if you, maybe I'll go back to the slide about, you know, this guy. So what's happening is that interest rate that these guys are getting is generated by the transactions from these guys. So every time there's a trade, there's a little fee that goes to these guys in the form of interest. So the more transactions that happen here, the more interest these guys will get. And this is a good model. I think this model is quite healthy and sustainable. And, you know, right now what happens is like all that gravy is now kept by your bank. So if you look at like how much revenue are the banks doing, you know, they're definitely earning like 15 or 20% internally, but you're not seeing it. You
So
know,
what
so
you're
like,
saying, and I know what you're saying by exactly. So what you're saying, it's the swaps and the trades, the fees they're making on the swaps and the trades, they're able to bring that straight over to the other players that are in the space because it's all automated, right?
yeah,
All of this is
exactly.
done on
It
smart
just passes
contracts.
directly through.
It's,
Yeah,
yeah.
that's right.
And so therefore, your typical investment bank has all of its overhead, right? With the offices
No,
and
yeah.
the phones and the FedExes and all the employees and their commissions on the ins and the outs, buy, sell commission, right? So they're getting all that money on that side. And these players in this space, decentralized finance protocols, it's totally 100% automated. And so they're very lean. And so you're thinking that because of that leanness, that they're deriving revenues really purely off of the swaps. Is there anything else? Just the whatever minimum fees that they're charging off their swaps. Where else do you feel they're making that kind of money?
Like I said, what I described, that I feel that's a sustainable good model. Like if you're earning fees from transactions, you know, with that, you know, I think you can get 10, 20%, but like you mentioned, like some outrageous numbers, like you see some protocols like advertising 200%, 500%, 1000%.
Yeah,
those are just scams, right? So like just flat out scams.
I went, you know, on Coin Market Swap, Coin Market Cap. You've heard of that website, Coin Market Cap. So you go Coin Market Cap and you look at the top protocols by rankings. And I just looked at the top 10 and I went into their liquidity pools. And even within the top 10, now I think you probably are right, but it is interesting that even within the top 10, you see some of these high percentages. So it could be, you think that's possible? I'm asking.
But
you think
I think definitely there's, I mean, it's like the early days of internet, you know, I'm sure you remember too. It's like, there's like, it's a gold rush, you know, there's scam sites, same here, you know, there's definitely scams happening. And you know, one thing that we're, you know, it's hard to say it's a scam, but it's definitely unsustainable. So there's kind of like a middle group, like on the one extreme, there's scams, on the other, on one side, there's like healthy growth. There's another kind of middle ground where a lot of these protocols these days issue what's called a DAO governance token.
Right.
So they have like this kind of separate thing, which is like a stock offering. They'll say like, oh, you know, let's get some capital into our DAO reserve, and then you can get voting rights to, you know, change these parameters. And then they'll offer the proceeds from that DAO token sale as incentives to grow the pool. So they'll give like an extra boost to the yield. But that's just like, you know, typical Silicon Valley, you know, burning investors' money to gain market share.
That's what I'm hearing.
Just not sustainable.
That's the first time I've heard that, and I think you're right. It sounds reasonable. It's called burn rate, right? And so you're burning the VC capital to build the entity, right?
That's right. That's right.
And so that's what it sounds like. You're burning the VC funds to be able to build the entity, and in this case, they're doing it by offering those higher percentages.
Yeah,
so
that's
percentage.
Exactly. That's that middle group. That's a middle group, and then of course you have scams, but we don't want to talk.
Oh yeah, that's another long conversation. And you and I could talk for hours just on the scam side of all of this alone. But go ahead. I'm sorry. That did answer a little bit. You gave me a little bit of clarity. I forgot about all those swap fees.
Yeah. So the swap fees generate yields, and those are healthy yields. Like you can definitely get, say, 5-10% healthy yield on a US dollar. It doesn't even have to. So like another thing is, one of the most popular tokens for these kind of swaps is actually a US dollar stable coin. So it's not, you're not really into speculative stuff. Like even Bitcoin is a bit speculative, but these are actually stable. I'm not sure if you're familiar with the concept of stable coin, but for example, there's a USDC token. And for every token on the blockchain, they actually hold $1 US in a bank account somewhere.
Right. But remember, just recently, God, only in the last week, even that stable
Luna
stuff,
UST.
The stable stuff is in trouble. You know,
that's because that's something else. That's called an algorithmic stable coin. So an algorithmic stable coin is something that tries to peg the US dollar, but it doesn't have collateral. So
That's right.
it's kind of like a losing game for sure. So
That's right.
that there's not many people who understand finance who invest in algorithmic stable coins. And it's kind of sad to see what happened. You know, a lot of people lost a lot of money, and
Well, it's down by $1 trillion, right? The entire market's down by $1 trillion just in the last week here or so.
Yeah, that's right. That's right. But, you know, having said that, you know, there's always going to be bad stuff, but there's absolutely, and I say this 100% sincerely, there's good stuff happening too. It's just like, it's not in the headlines, but there's definitely good protocols being developed, and there's good stuff happening, but there's also bad stuff.
Well, that's why I always say stay with the top guys. Just stay in the top space. You'll be safer.
Mm-hmm.
Don't go below. I always say don't go below 10 in the ranking, because that's where things start messing up. Stay at the top.
Yeah.
You know,
well, sadly,
anyway,
the Luna thing was in the top 10. So
that's right, and that's what makes it really tough. But that, remember, because you're a Wall Street guy, or you had spent some time on Wall Street. Remember the whole thing about diversified, right? Is you diversify because you know some of it's going to go south, and so you look at the old pyramid, right? With the pyramid, you know the stuff at the top is going to be risky. The stuff at the bottom is going to be ultra conservative. So how much can you afford to put in the top of the pyramid where you know you're going to have some losses? That's what happened with Terra. But nobody certainly expected that. They thought that would be in the middle of the pyramid. Instead, it wound up being at the top.
Sure. Okay.
Go ahead. I'm sorry.
Cool. No problem. Yeah, it's probably good if we don't talk about specific tokens, because that could be happy to discuss separately. But so anyway, so like getting to like, so I think there's some idea about how these pools, you know, there's this concept of pools and peer-to-pool concept. There's some financial engineering involved to make that work. You know, I've done the research, now I build it. So how do you build it? So this is where I'm, I hope you guys are interested in how I build this thing. And so like, remember I said like, okay, so I published that paper in November. It's kind of funny, if I look at the Remix GitHub repository and I look at contributors, if you look at who started contributing around November, Kent C. Dodds, right? So like, I don't know if you guys, I'm sure you guys know Kent C. Dodds, like he's a superstar, he's an awesome guy, but like, when I saw him talking about Remix, and if you haven't seen it, you gotta see it. It's like, you have to try it. Like, you have to be kind of like a cold, heartless person not to try it after seeing how excited he is about Remix. He's a very smart guy. So like, why did I try Remix? It's basically Kent C. Dodds, right? So he was so excited about it, and he got me to try it. And not only because of that, but also, there's certain things he mentioned, like having this kind of, it's very curious to me seeing like server code and client code in the same file. It's like, it's quite weird. So like that's a bit details of the Remix. I think, I don't know the level of knowledge of Remix here. This is not really, I'm not really qualified to give a tutorial on Remix itself, but yeah, so Remix is server side code. This is the first time I've ever done any server side, so it's all new to me, but it's all very cool. And this idea of having like a GraphQL client doesn't have to be in your browser. It can be here, and so like you could get very lightweight stuff going into your browser with still the power stuff here. And so like this is all new to me. It sounds very cool. So I tried. I started building my app right around the time Kent C. Dodds was like starting his contributions to Remix. So it's good timing. And I'll just say, so you've got somebody on board here. Just so you know, you got somebody on board. I too have spent thousands of hours programming websites, MySQL, ASP, PSP, JavaScript, cascading style sheets, all that stuff. And I've been using Remix, and I have indeed been looking at smart contracts, thoroughly studying smart contracts using Remix to do it, instead of a couple of the others. As we know, there's some other options outside of Remix. Yeah, sure.
But I have been looking at Remix, so
yeah, for sure, check it out. So like, I mean, like I put in the intro to the meetup. It's like, what a time to be alive. I mean, like you've been doing this for a while. If you're a young kid and you're learning web dev, what a time to be alive. I mean, it's just so amazing, like what you can do today. It's so exciting to think about what people will do. So
I wish I was 20 years old again. I really wish I was 20 years old again.
Me too, but I'm having fun. So like they're still fun to have. So Remix is, you know, this web framework. Got to check it out if you haven't. So I'm using Remix for my front end. You know, I always rely on the Remix Discord. So like Discord is like my 10-year-old kid loves Discord with his friends, but Discord is not just for kids anymore. Whenever my son sees me on Discord, he's like, "Daddy, what are you doing on Discord?" But you know, there's a lot of good stuff having on Discord. So I'm constantly getting help from the very helpful Remix people from the Remix Discord. And one of the things they recommended, because I suck at CSS, so like whenever building a web page, you have to do styling and components, and I really suck at that. I'm a startup founder, so I'm trying to bootstrap myself, but you know, I don't want to fiddle with CSS. But so somebody introduced me to Mantine. So that's just a beautiful. Check that out if you haven't seen it. It works very well with Remix, and you'll see. Like I'll show you my demo. It actually looks okay, and I suck. It's like if somebody like me can do something that looks okay, then like it's just what a time to be alive. So anyway, and then right now I'm deploying using fly.io, which again I learned about through Remix and Kinsey Dodd's videos, etc. It's just so easy to deploy something, like even I could do it. So like if I can do it, anybody can do it. And then like just kind of walking through this a little bit. What is Moralis? So like Moralis is kind of the glue that will connect your Remix app to the blockchain. So the blockchain itself, like Ethereum, there's alternatives to Ethereum. I'm also considering deploying to something called Avalanche or Solana. But right now I'm starting with Ethereum. So Ethereum is this blockchain the way I think of it is it's like a server for the universe. It's not owned by anyone. It's not, you know, managed by anyone. It's just out there for you to use, this kind of server. It's not very powerful. It's limited in what it can do, but it's indestructible. It's decentralized. You know, it's trustless. You know, it's battle tested in kind of hostile environments. You know, so that, you know, it's secure. So you have a lot of really good things about it, but like the blockchain itself is hard to work with. You know, so it's like complex data structures. You know, you don't want to, if you want to start building a decentralized app, you don't want to like set up a node for yourself and start querying the blockchain. That would just take you forever. So you could easily spend a year kind of setting up the infrastructure just to talk to the blockchain. But thankfully, Moralis is there for you. So it's kind of like they've done that work for you. So Moralis is kind of like, it's not a decentralized thing itself. So Moralis itself is a centralized platform. It's a web platform. They've got their servers, they've got their databases. But what they do is they kind of process the blockchain for you and they watch it in real time. So their databases are updated in real time. So now you can connect a Remix app to the blockchain using this Moralis SDK. So it's essentially a glue between your front end and the blockchain. And there's one other piece, and this was quite challenging for me with the Remix. So I'll kind of tell you the challenges I had with the Remix, and if you guys have ideas or suggestions, I'm happy to hear. But you know, so between Remix and the blockchain, there's this Moralis, but then there's also this thing called Metamask. So Metamask is actually a browser extension. So if you're very fluent with Remix or web development, and now I say, oh, you have to interface with a browser extension, you can probably already start to imagine the challenges that will come up, because like now, how are you going to do server-side rendering when you're having to interact with the browser extension? so the browser extension is by definition in the browser, which is on the client. So when I first started, that was the first challenge for writing decentralized apps, is that to actually do a transaction or to interface with the blockchain itself, you need some cryptography. You know, it's all about security, cryptography. You have a private key, you have a public key, you know, and you need to sign transactions. So this Metamask it's called a wallet, which does kind of the cryptographic signatures for you so that you can interact securely with the blockchain. But that typically runs as a browser extension. So when I first started doing this application, Moralis has a nice React library. So they have like your React hooks. So you can pop open your Moralis React hooks and start interacting with the blockchain through Metamask, et cetera. And so I set up my kind of baby toy model of Remix, and then I started using the Moralis SDK as a React hook. But like when I got the first version working, I realized like all my logic is in the client. So why am I using a server side? So like the powerful thing about a Remix is that it's server side, but all my stuff was residing in the client. So why am I using Remix in the first place? So then I said, okay, let's try to move everything up to the server. You know, so I rewrote my app again. I said, okay, let's try to do everything from the server. But then like after I got everything working, except like the last thing I did was the transaction, then I'm all, oh wait, I need that MetaMask thing. Like I can't reach the MetaMask through the server. So now there's the challenge with the Remix and decentralized apps is like, where do you draw the line between server and client? Because some stuff just absolutely has to be client because it's interacting with the MetaMask. Some stuff, you don't need to interact with the MetaMask because it's like you're just querying general information about the blockchain. Like if I just want to know, this contract, what's inside this contract, you don't need a user input. Anything related to the user, you're going to need, like, if you're going to do a transaction, you need the MetaMask to sign it for you. So what I kind of ended up with was this kind of hybrid. So stuff that I could move to the server, I move it to the server, and stuff that you can't move to the server, I leave it in the client. So I kind of went through 3 iterations. Number 1 was everything in the client. Then 2, like I tried to put everything in the server, but that didn't work. So I ended up with the kind of hybrid. And so that was kind of interesting. And I'd be very interested to see how far you can push it, like push more stuff to the server. But then now, how do you get your MetaMask? Because you're going to sign stuff. Are you going to send a signed transaction to the server? That could be an idea, but that's a little bit beyond me now. So I that's like above my pay grade. So like in terms of how to get that, I think that'd be very interesting. So if you guys are interested in decentralized apps, that'd be probably a challenging thing to think about. And I'm sure you can probably find solutions. I don't have a good solution for that right now. And then, so another piece in this puzzle is like, okay, so Ethereum, the smart contracts themselves. So like you have the front end. I think, most people will probably understand how that works. And then you have the blockchain on the other side. And the blockchain is, that's where smart contracts come in. So now how do you write our smart contracts? So smart contracts, that's where this kind of middle row comes in. So that middle one is called Foundry. So Foundry is a tool for building and testing smart contracts, essentially. So it's written in Rust. Again, like what a time to be alive, because this thing literally came out around the same time Kinsey Dodds started talking about Remix, was right around the time that I finished my math paper. So I'm like sitting here, like all this amazing stuff is coming out right when I need it. So Foundry is like an amazing tool for building and testing smart contracts. Kind of the workhorse before that was this Hard Hat underneath. So Hard Hat was kind of like becoming one of the standard workhorses for building and testing smart contracts was Hard Hat. This Foundry is kind of a new thing, but it's.
Can I just ask a question? Because as you're now bouncing between these 3, Rust is a different language than Solidity.
That's right. That's right.
And so when you're doing Ethereum, you're doing smart contracts in Ethereum, you're doing Solidity. But then if you do Rust, you're doing something different. And is Rust, what I don't know is, can you do Rust in Remix? Well,
no. So what's happening here is Rust is actually the Solidity compiler is written in Rust. So you're not actually doing any coding in Rust. It's just the tool chain to build and test your Solidity. So the contract is written in Solidity, but then the tool chain to build and test those Solidity contracts is written in Rust.
Okay.
You don't need to know Rust.
I got that.
So,
But then
and then
hard
because of
hat,
that, it's just very fast. Yeah.
okay, and then hard hat, to my knowledge, is like a bunch of others. It's really just an alternative to Remix. And I see a lot of,
Oh.
a lot of, well,
Yeah.
I see a lot of smart contract guys over on
Oh, I see.
what's that site where we see all the code? All the coding is over there.
Yeah, GitHub.
GitHub. So on GitHub, I see a lot of these smart contracts that are indeed done with hard hat compared to Remix.
Right.
But in other situations, I see everybody saying use Remix, use Remix, but then in other situations,
I
it's all
see.
hard hat.
Hold on a second. So
yeah,
I'm sorry to interrupt you, but
no, go.
I should have clarified this point because this is like a very unfortunate clash of terminology for anybody who's doing web dev and anybody who's doing decentralized applications, because the Ethereum Foundation, which is the creator and the governance body for the Ethereum blockchain, developed a smart contract development tool chain, and guess what it's called? It's called Remix. So like
correct. Yeah, they
so
created
that is different.
Remix.
So,
yeah,
but what I'm trying to clarify here is that the remix that I'm talking about here is not the remix. I'm talking about is a web development framework that's called Remix, and then there's another smart contract development framework that's also called Remix, but that's a different thing.
Oh.
So there's a terminology clash here, and it's kind of unfortunate because so whenever I talk to people who know both, which is rare, so like it's not every day I talk to people who know both the Remix smart contract and the Remix front end. So whenever I talk to people who know both, I will usually qualify the Remix web as call it Remix run. So it's Remix run, it's a web dev, and then Remix is the Ethereum smart contract. There's two different things. So what we're talking about in this top left corner in this chart is the Remix web, and I'm not using the Remix smart contract at all, but you're right, it is alternative to hard hat. So like this bottom thing, the hard hat, some people could do that with the Remix, but I would say like for bigger projects and more involved projects, you probably don't want to use a Remix because it's more like a web. It's more of a web-based ID. Hard hats is more for like industrial.
That's right. That's right.
That is definitely unfortunate.
I wanted to clarify that with you because I do the difference.
Yeah, sure. Yeah, sure. I'm glad you bring that up because it is kind of important that there's two different remixes. In my talk, I should definitely have clarified that because both are coming up. So anyway, so these are all the tools that kind of go into building a decentralized application. Foundry, another super cool thing about Foundry that I love is like your smart contract is written in Solidity. Foundry lets you also test in Solidity. So like it might sound like a no-brainer, like, oh yeah, you need to test in the same language that you're writing your code. Like if you're writing C code, your test should be written in C. If you're writing like JavaScript, your test should be written in JavaScript. If you're doing Solidity code, your test should be Solidity. But that prior to Foundry, that was not the case at all. The tests were done in JavaScript. So your testing framework was in a different language than the language you're writing your smart contracts. And that context switching is very hard. I'm sure you guys, whenever you have to change context, it could take me a day just to change the context from one language to another. So whenever I'm doing smart contracts in Solidity, then I have to do some remix front end work. That's a big change in mental. This is a big mental change, so it takes some time. So Foundry is great because it allows you to do your building testing in the same language that you're actually writing the code, and that didn't exist before. So again, what a time to be alive. So like, you can actually write your tests in the same language. So that's all good. And then let's say I think I talked quite a bit about all these pieces. I didn't go into too much detail about this. I kind of talked about some of the challenges. Before I go on, any questions about any of this puzzle pieces?
I don't think you mentioned, what is it, Mantine and Fly. You didn't talk about
Oh,
that.
Mantine is the styling. I was talking about like the CSS
Oh, okay.
stuff.
Okay.
So Mantine is like a very nice UI component library with kind of built-in styling and stuff. So if you're trying to build a dashboard or something and you need nice looking UI components.
Well, what's Fly? I don't think we talked
Fly
about
is
that.
it's a edge-based deployment service. So like you can deploy your application to Fly. So it's like it's a cloud-based service for deploying your web.
Is it a node?
Yeah, kind of like a node. Yeah, I don't know too many details about this, except like I think, you know, they try to have their servers closer to the user, so they emphasize kind of the edge. But I don't know too much about that. I'm kind of like an old school Azure guy.
So. You know, because a lot of smart contracts, you deploy them on nodes. That's it. That's how you deploy them.
Yeah. So okay. So any other questions before I move on? I think from here it's just like kind of a bit of a demo. I can show you like what I actually built and some stuff about that. Okay. I guess I'll go into that. Let's see. So this is what it looks like. Okay. So hopefully you don't have to.
Can we go to full screen on that, Eric? Is it possible to make that full screen? Love looking at you, but can this go full screen?
Oh, let's see.
How do we make those images go so we see them?
Oh, that could be a part of your Zoom, your client. I'm not sure what you need to do. If anybody has any ideas, so it's basically.
Ray, you should be able to adjust your own UI to like drag it or.
So I should be able to do it. Okay.
Yeah, I think that's how Zoom does is they give each end user the abilities to adjust it.
Okay. All right. I'll mess around with it. Thank you. Oh, I did it. I just did it. Thank you very, very much.
Okay. Nice.
I made you guys small and it's big. Thank you.
Good. So anyway, so here's the, you know, this is like a live, this is deployed already. It's deployed not, so like one other thing I didn't mention was blockchain, you know, you have to be quite careful about deploying stuff to a blockchain because it's like permanent. Like you can never delete something from the blockchain. Once it's deployed, it's there forever. You know, there's good things about that and there's bad things about that. Because like if you have a bug, you can't really fix it. It's so like they have like what's called test chains. So they have a test net, which is like nets. So this is deployed on a test net. So it's not deployed on the main net now. It's deployed on a test net. And so I got kind of two versions. This is a Chrome version and this is a Brave version. And I just kind of show that because this one I do not have this little box here, the Metamask. So like if you do not have Metamask extend, like I mentioned, Metamask is a browser extension that handles the cryptography and security, your signatures for transactions and stuff. If you don't have it, my first version of this, you had to use a wallet. You couldn't even see the app unless you log in with your wallet. So like I said, well, that's not great UX. If somebody just wants to come here and play around with it, I should give them the ability to play around with it. So this now, if you come here without a wallet, you can actually hit the swap and you can play around with it. But here on the Brave, so I use Brave. I use Chrome for browsing and stuff. So who knows what kind of cookies and security. But like Brave is more for stuff I want to keep more secure. And so if I click this guy, then you'll see what kind of the wallet looks like. So something like this will pop up. I'm pretty rich here with 3,000 Ethereum, but this is on the test net. So this is fake money, unfortunately. So like I've got this Metamask is connected to Robson test network. I've got some Ethereum here. Here's my account number. And then, but it's not connected yet. So like I have the Metamask, but this every application that wants to communicate with the blockchain has to be kind of registered with Metamask. So it is registered, but I'm not connected. So if you want to connect, then this comes here. And this is pretty cool. I think, you know, as blockchain becomes more mainstream, which I think it will, you know, this is quite a good way to do authentication generally. So you know, log in with Facebook or log in with Google. Now you can log in with Ethereum. is quite easy with a Metamask. So you can do authentication with blockchain, which is pretty cool. So that's essentially what I'm doing now. So I'm authenticating myself with Metamask. And so I don't know if you noticed what changed, but here, if I'm not logged in, then this is just generic information about the pool. So remember I said there's different pools. My model is different because my model, like Ray mentioned, that Uniswap is pairs of tokens. Mine can be any number of assets in the pool. And I think that's a huge benefit. So here I've got kind of 5 samples in one pool, and then you got price, reserve fee, etc. But now I'll log in again so you can see the difference here. So once I authenticate, now it pulls down my actual token balances. So this is reading from the blockchain. So these are my balances on the blockchain. I connect with MetaMask. It knows who I am. It goes through the Moralis SDK. Moralis is actually in it. So Moralis is getting the live data from the blockchain into its database. I'm querying that data and then pulling it down. So now you can see my balances here. And since this is a testnet, like one thing that's kind of challenging, like for me, like I've been coding forever. I don't consider myself a developer, but I'm kind of a physicist. I write models, I code models, so like I've been writing code forever. One thing that's kind of weird for me about writing decentralized apps is like, it's got economics built into your code. So it's like, it's quite a different feeling because you're coding money. So it's like every line of code you write, it's going to cost money to execute because it's called gas in the network. So if I want to like do any interaction with the blockchain, I need to have some balance of some token. In the case of Ethereum, it's called ETH. So like I cannot even run my code, not even to test it, unless I have some resource. And that's quite like it's a little challenging. Like for me, I just want to do a simulation.
But you can get as much test token as you need.
Yeah, so they have things like faucets. So they have faucets where you can ask for it. But still, that's quite different. What my point is just like,
right. Without it,
you need some
anything.
resource. Yeah, you can't do anything, which is kind of interesting.
Right.
So like if you want to play around with this, kind of like the instructions to kind of play with this is a little complicated because the first thing you have to install Metamask. So you need a wallet. And then you need to connect your wallet to Ropsten Test Network. Once you have your MetaMask connected to Ropsten Test Network, you still can't do anything because you don't have ETH. So now you need to go find a faucet so that somebody can mint some tokens to you so you can actually start. So there's quite like some steps to do before you can actually start playing around even with the testnet. But once you do that kind of setup, then you can start interacting with it. Like I said, you can interact with this without being logged in because this is kind of what it looks like here. So this is just like my dashboard. So when you first open it up, you have, this is like this, what's going to go into the pool is here. So you can select, which tokens are going into the pool. And then this is what's coming out of the pool. So this is a little unique in that it's something I call multi-asset swap. So it's like, typically when you're trading currencies, you'll say, hey, I'll give you some US dollar, you give me some euro. But now with this, you can do kind of multi-token trades. You can say, I'm going to give you some wrapped Ethereum plus USDC, and I want some pool tokens with some USDT back. So here there's some.
This is similar to 1inch. You familiar with 1inch?
Yeah, 1inch is an aggregator. So 1inch,
but
they will connect to.
But you can do multiple. With 1inch, you can start with one, and you can go on multiple tracks, and you can swap multiple tokens within each one of those tracks.
Yeah, but what it will do in that case, it is a little different. So like for sure, so like in that kind of case, what it's doing is saying like, oh, I want to swap this token pair and this token pair and this token pair. So you can kind of combine a bunch of token pairs into like one trade and then submit that all.
Right. Right. I mean, that's the
This-
smart
this-
contracts I'm writing. That's what they do.
Yeah.
And 1 inch, what I just referred, this is exciting what you're doing here. 1 inch, what 1 inch does is they have a back-end AI user interface. And on that back end, you can say how many tracks, how many tokens. It automatically selects the different tokens, the multiple tracks, so that as it does all the swaps and trades, it generates the most amount of profit.
Yeah. That's called a routing problem. So like when you have currencies, like if you're trading token A with token B, it might be cheaper to go A to C and C to B.
That's
So
right.
it'll find the most efficient.
It finds the
And
best.
Yeah.
Go
I'm
ahead.
sorry, guys. I didn't realize that the time flew by. We're already like 15 minutes past 6. So like I'm sorry about that. So like I'm just having fun. So I apologize. Basically this was, I wanted to show you, I wanted to kind of convey some things like the Metamask issue, and have this kind of the Metamask having a browser extension kind of challenges a Remix app design a little bit more than usual, and then, I don't want to talk too much about my startups, but this is just, this is different than what you're talking about, because this is a true multi-asset swap where it's like you can have 3 go in and 2 come out, or 10 go in and 4. So the mathematics actually calculates internally this in just one transaction. So it's not a batch of a bunch of 2 asset swaps.
Or a bundle.
It is truly, it's not a bundle. It's truly is a, it truly is a one single multi-asset swap, which now there's all kinds of
Did
cool
you
things.
create this for yourself, or is this, are you seeing that this would be a portal or application?
Well, no, this is like this is my startup. So I'm working on this.
Oh, this is a startup that you eventually want to launch and people will use this.
Yeah, that's right. So it's testnet now. So once I iron out some bugs, eventually I hope to launch this on mainnet. So yeah, to get actual people using it.
What's the like use case for this? Like rebalancing a portfolio or something of?
Yeah. So a lot of times, like I said, when you have these pools, there's this important symbiotic relationship between what's called LPs or liquidity providers on one hand, and then the arb traders or the traders on the other hand. So the traders are what generates fees, and then those fees translate to interest to the LPs. So the LPs are happy because they're earning interest on their deposits more in a passive sense, and the traders are happy because they're finding arbitrage opportunity, which means they're finding like mispriced tokens that then they can trade somewhere else for profits.
Yeah, arbitrage between the portals.
Yeah,
but his question is the same as mine, and maybe I can help get it closer so your answer is more defined. What is the purpose of this? I'm thinking it's exciting, but is it a potential user interface aggregator? Because it's one of the next steps that I'm thinking of going. I'm doing ARB right now, just ARB, between multiple portals and multiple currencies. But the next step is to be able to do indeed liquidity pools, farming between multiple portals with multiple currencies, and have one application do that auto. And so you can assign, let's say, 5 different portals. And within those 5 portals, you select, let's say, 6 different pools in each portal. Now, what they're doing automatically, what they need to do automatically is keep pulling, staking and pulling, right? That's farming. And they're doing this on a 7-day period. And while they're doing it, they're balancing. They're balancing within the portal, and they're balancing the total pool of funds available between all the portals. You understand what I'm saying? So you're doing something really close to where I wanted to go next.
So this is quite, this is, requires some significant financial engineering, some significant mathematics to get this to work. I imagine most people would just use the simple swap, like they say, 1 token in, 1 token out. But kind of asking about kind of use cases for the multi-token kind of stuff, that's where kind of like if you can do these kind of multi-token trades in one shot, then that opens up more opportunities for arbitrage traders, because there might be an arbitrage trade where like these 3 tokens are mispriced. So like now I can take advantage of that mispricing in one shot. You know, so like, so you can imagine people writing algorithms to kind of construct an optimal trade that can take advantage of an arbitrage opportunity. There's another thing that, you know, it's a bit too technical, but like, you know, there's are ways for the miners to extract value from some of these trades. And so like one thing that this, you know, if you come up with a great algorithm and you come up with a great arbitrage trade, it's called a sandwich attack. The miner can put a trade before you and after, and then your trade becomes useless because they this kind of sandwich attack.
So
this kind of stuff,
they're front running, back running, and
pretty much
sandwiching. And sandwiching.
Sandwiching. So this is a form of protection against that. So like, you know, there's one idea I had, like you can actually bundle all the trades from every single person into one mega swap. You know, and then you can actually say like, I'm only going to allow one swap in my smart contract every block. So every block will just do one swap, but that one swap is a bundle of everybody's swaps. So it's a mega swap and it only allows one. And because a contract only allows one, no miner can do a sandwich, because to do a sandwich, you need a trade before, you need the trade, and then you need trade after. But if your contract only allows one trade, then it has to be your trade. Otherwise, the miner won't even get any money for that. So it's like, so there's all kinds of uses for this, you know, practical uses. One is like finding arbs. Another one is what's called minor extractable value, you know, this kind of front running stuff to avoid that. So it's kind of a protection, you know, so those are some of the use cases for this. And yeah, it's still, you know, if you're, I'm like I said, we're over time, so I should wrap up, but like, you know, when we kind of talked about doing this thing in the first place, I didn't realize it's going to be online. So like, I was like, oh, I'm going to meet some people. I'm so excited. So like, I'm pretty new to the area. I'm in San Jose, West San Jose, Cupertino, you know, and, you know, I was in Asia the last 10 years. So like, I just returned after 10 years in Asia. I don't really have a network around here. So like, just like personal level, if any guys find this interesting and want to like reach out and chat, have a coffee or something, you know, I'd be happy to, you know, stay in touch and meet people. Because yeah, my network is strong in Asia, but here it's like, I'm starting over. So like, I'd love to start plugging into.
I'm in San Diego, unfortunately, but let's do it. Let's do it through phone and text and Zoom.
Yeah, sure. And so here's my contact, my email. You know, my Twitter is just first last name at Eric Forgy. And then I think I saw somebody put the Discord thing. I'm quite active on the Discord, so like if you want to join that, you can kind of follow along with the progress. And I'm maybe too transparent, like I'm talking about everything I'm doing like in the Discord, but it's just a lot of
they'd call this a lot of alpha right here. You've heard the term alpha with all of this?
Oh yeah, of course, yeah.
I mean, this is a lot of alpha coming at us right here. This is
alpha leak. This is alpha leak.
Yeah, this is alpha leak like you wouldn't believe. I mean, this is extremely exciting stuff. I didn't write down your email yet.
Okay, yeah, no problem.
I will, Eric. I'll be in San Francisco tomorrow all day. If you want to grab a coffee.
Oh, I'd love to. Yeah.
Okay. I'll reach out to you on Discord.
Okay, sounds good.
And where's the Discord for you? Just on that same email? How do you find you in Discord?
Oh, that's if you email me, I can send you a link. Yeah, this QR code. If you point your camera at the QR code.
All right.
The link's not easy to write down, so if you email me, I can send you
I myself, like you, I'm a 24/7 guy. I'm doing this stuff 10 hours, 15 hours a day. And so I'd spend some serious time with you on this. This is
I'd be happy to follow up with you. Fun stuff.
This is mind-boggling.
Yeah, you hear so much, like for sure there's scams, and that's unfortunate, and that's going to happen anytime there's something new. But there's definitely good stuff happening, and there's a lot of brain power. I'm sure all of you have seen, very smart colleagues leaving to go work in Web3 startups.
Oh God, yeah.
There's definitely brain drain and stuff. So
I've been following the MEV people, because you mentioned it. I've been following those guys extensively, and reading all their university papers and studies on all of this stuff. So yeah, I'm pretty up to speed with that. Yeah, you're right. There's scams a minute in all the spaces, exchanges, portals, and NFTs. It's all over the place. But at the same time, there's a huge amount of benefit that will come out of this. And it is what you said earlier. I lived through, without the long story, I was really involved in the beginning of the internet, really involved.
Yeah.
And so I went through that whole thing with all the players, and know what it was like, and thought that it was all going to fall. The internet bubble burst, right? All that stuff, so this will get somewhere at some point, and we're just seeing it in its very early stages. The DAO side of this is another major conversation.
Yeah, well, right now, like the one, like the main centralized piece to all this is still like the Moralis is like a centralized server, but there's exciting stuff going on also in like decentralized servers. So like at some point you won't even need these centralized servers anymore. You'll have these decentralized stuff, like the IPFS is pretty exciting. And one thing I just saw some news pop out about it. Are you guys familiar with IPFS? It's a funny name. It's the Interplanetary File System. And like Lockheed Martin is just teaming up with IPFS to kind of work on this for space communication. You don't want to have your servers on Earth if your spaceships are flying around space. So it's like, so this IPFS is actually quite useful for kind of space networks out in outer space, and it's a bit out there, but I kind of feel like this decentralized stuff that's kind of developing now will be kind of in the future. If you imagine like spaceships doing commerce in space, it's going to be some kind of a token. It's going to be.
I think from what I'm seeing, from all the stuff I'm reading, similar to what you're reading, is there's already over 40 to 50 networks out there, decentralized networks. There's already over 40 to 50 of them. And now we have a bunch of, compiler guys, or bridge. We got the bridge guys coming in, and the bridge technology and software, bridge smart contracts to bring all that together. Yeah, the multi-chain stuff. So yeah, it will go in 9,000 directions, and even Valtech there was saying, I think in one of the things I was listening to, we're saying, yeah, it's going to go that way. Everybody jump in, and that's what Solana's working on. Solana's like, yeah, let's do this in 9,000 different directions. Everybody comes up with something, but that opens up the opportunities for the guys who do the bridge part of it all. So no matter who you want to talk to, you have some way of communicating with whatever bridges you need to network with. It's another long conversation, but
yeah. Okay. Well, we should probably wrap it up, because I think everybody's leaving anyway.
Yeah, they're taking off on us.
I feel like this could probably be a podcast series that we start.
Oh yeah, this would be great. I love it.
Thanks for inviting me, Eric. It was fun for me to put this together, and I hope you enjoyed it.
Yep. Thank you for the amazing talk. I have recorded it. I'm actually going to stop recording now.